Alright guys, welcome back guys to another video here. Today I'll be breaking down one of my trades that I took about 2-3 weeks ago on gold. So I'm going to break down how I was able to find find this entry based on a few rules and market strategies that I have for my strategy that I use to enter on a day-to-day basis. So without further ado, let's start and get into the video. But before we start, please like, comment, share, subscribe. Let me know what you think about the video. Obviously drop suggestions and obviously price and charts that you want me to analyze and break down, and any other video suggestions that you have as well, please leave in the comments as well. So all right, so let's get into the video. So first of all, so let's go back in time. So by looking at this chart here, we normally, first thing we always want to do is identify what we call the market structure. So by looking at this chart, I can see that on a higher time frame, so let's go back here. So you can see that this is a bullish structure, meaning we're having higher highs, higher lows, higher high, higher lows, So this is showing us a nice bullish structure here on on the current state at the moment. So as you can see, we currently have two demand areas, demand zone, or what we call order block, or whatever it is that you call demand zone, supply, demand zone, area of interest, So as you can see, and as you can see here, this order block here is mitigated by this areas here, as you can see, because this was the last area that buyers and sellers has a bit of back and forth tug of war, so to speak, before price breaking this swing point here, creating a new highs, come back to retest this area of interest and then pushing upwards. Now, in order to understand the market much better, we always there are two types of markets that we have. So we have an efficient market and we have an inefficient market. Now, efficient market is a market that it can something look like this, where price always comes back and retest. So let's say we have a break of the high, come back, price come down, breaks the last high here, falls back to test the swing part of this high, pushes up, comes back and tests. So these are what we call an efficient market, so to speak. So as you can see, however, by looking at the current state, we can see that there was a massive momentum on price, pushing it to the upside and causing what we call an efficient market, which leaving a huge area of gap between, because as you can see, there was no pullback to fulfill any sellers or fulfill any selling orders, as so to speak, as you can see here. So all these gaps that we're seeing are what we call an imbalance. An imbalance is basically when there is an imbalance of price action between sellers and buyers. So therefore, because this has happened, what tends to happen is that market would have to retrace back to this area, well, back to an area that we call demand or supply zone on the market, so that it can balance out the inefficiency before price trending upwards or downwards based on the market structure. But for this example, because this example is a bullish market structure, so therefore what we're looking for is buy entries, because we're in a bullish trend. So therefore we will all be looking for buy setups to enter to the upside to continue the trend, because we always don't want to counter trend. We always want to be on the right side of the trend in order to make profits in the market, because we don't want to create our own, we're not market makers, we're just enjoying a ride, so to speak, especially for retail traders, because we don't have that much bargaining power when it comes to affecting how the market goes. It's mainly the institutional traders and banks and all these people. But anyways, back to the chart. So yeah, so as we can see, as I've identified as a fair value or imbalance, as we have here, and imbalance here as well. So therefore what that means is that we have to find an area that price would normally use it as a reference point to come and bounce off before pushing up to the upside to continue the trend. Now, by looking at it, we can see that price has already mitigated this area here that we can see, because this order block has been mitigated, meaning that we need to find another area that we can use as a reference point, as a demand area, for that price can push. Price can use it to push downwards, mitigate it, and then go to the upside. So therefore, we use this order block, because this was the last order block here that, and obviously we want to leave it as unmitigated, because this is just a a recap of how I was able to analyze the market based on what I was seeing at that time when I was looking to enter the trade. So yeah, so a lot of people would normally either use this order block here, because someone argue that this was the last candle before the price pushed, or the serious bullish momentum occurred. But I tend to use the order block to have the the lowest wick, in terms of the lowest wick above all, because sometimes you don't want to have a tight stop loss. You want to have at least a normal and good stop loss where you can use, so that you don't get hit out based on spreads or wherever your time of your entry is being hit. So now that we've found an order block, well, what we have to do is now wait for price to come to our area that we look to enter on a bullish setup. So let's play and see how prices axis up. So we have a nice first hit, so showing that this area is quite a very strong area of support, or quote unquote demand zone here. Now, so because we've gotten a mitigation of this area, what we want to do is now go on a lower time frame, because we understand that the area that we've chosen is a very high, was a very strong level of support. So therefore, this also gives us a first confirmation that this area we have is a very high probability area that price would bounce off to the upside. Now, since we know that, then the next thing to do is find the last high that caused this price to push all the way to the downside to our area of interest here. Now, so we can see it was this candle, or this wick here. This was the last swing, so price pushed up to this level here. So as we can see, price broke the structure. So the beautiful breaking the structure, starting to consolidate a bit, and then it was this candle that fully pushed it to the downside to fulfill our area of interest on the higher time frame. So therefore, I will be looking for a break above this price level here, so that I can expect, or I can see, that bulls or the buyers are in full control of the market as of yet, as we can see. So that is how I would normally look for buying opportunities, is by first understanding the high time frame order block or area of interest has been mitigated. Second, that's the first thing I want to do, and then go on a lower time frame, look at the last wick or the last price that causes this push to the downside to our area of interest, and then I would then look to see how price action shows, whether there's the market control has been changing from sellers to buyers, or sellers still have control of the market. So that is my second rule of how I would go about with identifying the structure and control of where the markets are so far, based on higher time frame mitigation. So price is trading sideways, as you can see. Now, obviously, as I said, we always want to see if this is going to be a break of this price action here. So watching the market, and then boom, we have a nice sweep of the price wick here, meaning that buyers are in control now. So since I know buyers are in control, now the next thing to do is find an area of interest I can use as a reference point, or as a place that I would use to enter for a buy trade to the upside, because I understand now that buyers are in control of the current market. So therefore, I need to find an area that I can enter into this trade to the upside. So this is where understanding the market is very, very important, and applying what you see on higher time frames into lower time frames as well, because it's still the same market you're looking at, it's just different charts. So because I understood that obviously we have a broken structure here, let me just mark that out so you can see. Now what my next thing is to do is find an area of interest, and this area of interest just sits right below this level here. Now the reason why, now your question we're thinking is, why did he choose this area of interest? Because again, this was the order block. A lot of people would choose this area and say, oh, this was the order block that broke price structure to the upside. Yes, I agree. This order block was the order block that did break price swing high to the upside. Now you have to understand that market is a very tricky market, and if you don't understand these things about the market, it's because the reason why I didn't choose this area is because I realized that there's a fair value gap, meaning that buyers had a heavy amount of orders in the market that it caused an efficient market to happen, breaking its internal structure here. But however, there was no pullback to our area of order block or area that caused this huge spike to the upside. So therefore, I understand that because of this fair value gap, I would expect, or I should expect, the market to pull back to this area here, and then I can then be fully comfortable with entering a buy to the upside here, which is where I normally set my take profit. My first take profit is the last swing that caused this huge downfall based on the high time frame here. So this is how I looked at, and this is what I was observing, because it's very, very important to always understand the imbalances and liquidity, because these are the things that normally sets traders apart, advanced traders and beginners and intermediate traders. So this is an imbalance on the 15 minutes. So therefore, because an imbalance is here, my next thing to do is find this area, or find the order block that caused this imbalance, or the last order block that pushed price down before the full momentum of bullish breaking this high here, and price failing to push upwards. And a lot of people would argue that there's liquidity here in terms of equal lows here. So therefore, because there's an equal lows, well, what that means that there's a lot of stop losses that are below this point here, because again, this is the last order block that break this high on the higher time frame that we're looking at. So therefore, we can argue that there's an equal lows of on this point here, and because there's an equal lows and an imbalance, this is a perfect area then, that, or high probability area that we can use as a reference point to enter into our buy trade. So therefore, what I did is I put a buy limit here into my trade here, so right here, and put it, take profit right here. It was a nice 10-hour trade that we did, and let's see how the market played out with this trade. So we have a nice hit, price trend upwards, beautiful, and we have a hit on our first take profit. So this is how I found my trade on gold. So it's literally 3 simple steps. Is first, identifying the market structure on the higher time frames and finding a high probable area of interest, or point of interest, or order block, whatever you call it, and then go on a lower time frame, finding the last swing that caused the break of structure to your point of interest or area of interest, and then you watch this area of interest, this point, this last swing point that create this downwards to your area. Watch that price breaks this last swing, and once price has confirmed that it has broken this last swing, you look for the last area that caused this swing, or look for imbalances or liquidities or equal lows or equal highs, and then you can use this as a as another way to mitigate and find the higher probable areas that you can enter a trade on for a nice risk to reward trade of ratio as well. So these are the top 3 things that every trader must understand whenever they're looking to enter a trade. It's all about understanding market structure, finding your point of interest is, going on the lower time frames, and finding using that same metric on high time frame but on a lower time frame for execution wise. So therefore you're able to mitigate risk and obviously enter on a nice low risk and with a probable of a high return as well. So this is how I was able to get my trade on gold. So yeah, and obviously I will show you the pictures of when I posted this in my Telegram. You know, it's free. Check it out. Active within a daily post setups and sometimes clips of breakdowns of charts and currencies that I'm looking at for the week. So yeah, let me know what you guys think in the comments. Find this informative, find this very educational. Let me know what you think and drop your suggestions and anything else. And you've been your boy Owen Capitals, and we out. Peace.